Good morning, I'm Gemma Bruce, Client Portfolio Manager on npower's Optimisation Desk. Welcome to today's market update on Friday the 27th of May. So to summarise this morning, gas prices have opened roughly flat to a touch higher on the near curve as a short system due to above seasonal normal demand is supporting the curve there, while further out the seasonal contracts are trading flat to a touch lower, taking their direction from a slight easing in the oil markets and also the strengthening of the pound. As normal for a Friday, power markets have been slow to get going, but do look set to follow the movements of the gas and open a touch supported on the near curve and flat to a touch lower on the seasonal contracts. So if you have any questions, please do contact us on the displayed email address, or for more detailed information, continue to watch. So the line pack this morning has opened undersupplied, currently forecast to close 9 MCM short. And this is largely driven by higher demand, which continues to be above seasonal normal due to the high levels of gas-fired generation online, with CCGT generation currently making up close to 54% of the power stack. Gas flows remain roughly in line with where they opened yesterday. Langlad currently flowing to the UK at 30 MCM, with LNG send out combined 38 MCM across both the Dragon and South Hook terminal. The Moser tanker has now been confirmed as heading to the UK due to dock at the South Hook terminal on the 29th of May, which will take the total number of tankers arriving in the UK across the month to 12. Power margins remain comfortable today, with the peak forecast at around 13.6 gigs, and this comes despite low wind generation, which is below 1 gig today and is not expected to pick up any great deal across the duration of today. As a result, we have seen gas-fired generation ramp up to cover the shortfall. We've also got steady nuclear generation at 7.5 gigs, and both the interconnectors importing to the UK at full capacity. Elsewhere, oil prices have steadied below $50 per barrel this morning after surging yesterday afternoon on the back of a larger than expected drawdown in US stockpiles. The slight easing of prices this morning is, however, being attributed to the restart of production in Canada following the wildfires there we saw earlier in the month, which saw production cut by 1 million barrels per day. Upside risk does, however, remain in the oil market, with a number of production niggles continuing and also with the global supply gut slowly being eradicated. And it certainly does seem that Saudi's strategy is finally paying off, having squeezed out rival producers, which could suggest that they may be more willing to participate in a production freeze, which is due to be discussed at the next OPEC meeting. The pound volatility against the dollar is at the highest rate in 6 years as the referendum date looms on the horizon, creating a dilemma for currency traders on how to protect themselves against the fallout of the UK leaving the EU, without losing money should we remain. Options on the most traded currency pair, so the British pound and the US dollar, are at the most expensive on record, leaving traders to look for other solutions to protect themselves against the Brexit turmoil. The pound this morning is worth $1.4644, which is 0.96% up on the week, while the pound against the euro is up 1.37% across the week. So that concludes my market update for today. I hope you have a lovely weekend, and we'll see you at the same time again on Tuesday. Thanks very much for watching.